All right, in this lesson, we're going to walk you through a very specialized topic when it comes to depreciation, and that is an asset impairment. So let's talk a little bit about asset impairments and what this means and how do we calculate asset impairments at the very end of this lesson. So depreciation, the related book value of the asset, is not supposed to represent fair value of the asset. So when we look at the book value on our books of our asset and then the fair value, what we would get in the marketplace, often they will not match. And that's because we're using a systematic approach versus what the market is telling us it's worth over its useful life. So depreciation is a method of allocating cost over a period of time, whereas fair value is what the asset would get in the market. And the problem with trying to match book value with asset value is that every year we would have to reevaluate the asset's value in an open market. Well, we're really not selling it in the open market, so it's not really worth what the market is telling us it's worth. It's really worth what we can get from it, from using that and generating revenues in our book. So there is a difference here that we might have. However, sometimes the value of the asset drops so significantly that an impairment does occur. Now, what do we mean that drops so significantly? Well, an impairment is a situation where the company's ability to recover the value of the asset through the future operations is hindered. So what we're saying here is that a company might have on their books a machine that has a book value of $1 million. And if we look through what that machine is going to do for us in the next, let's say, 10 years, it's only going to recover $250,000 of sales or revenues. So technically, our machine has realized an impairment because it really isn't worth $1 million when the machine can only generate $250,000 of revenues or sales back because of that machine. So we're not going to recover $1 million. We're only going to recover about $250,000. So that is an impairment, and we're going to have to deal with that by writing that asset's book value down to what we're actually going to recover. Okay, so what are we going to recover at the end of the day? $250,000. So we're going to have to take a loss on $750,000 on that equipment because it just can't get us $1 million of equipment value. Okay. So that's what we're going to do. So there's two steps in the impairment. The first step is we're going to eliminate the asset's accumulated depreciation against the asset account. So this is the one time where we're going to reduce the asset's value on our books to a point where we kind of remove the accumulated depreciation. Once we've removed the accumulated depreciation by reducing the asset's value, then we move on to step 2, which is writing down the asset to its fair value, what it's worth in the market. Okay, so that's what we're going to look at doing when we look at the impairment. So the best way of watching this or doing this is to actually do a problem. So assume a company purchases an equipment for $10 million 10 years ago. Today, the asset has a book value of $6 million. So what we're saying is that it was worth $10 million here, and then it's now worth $6 million here. So that is a $4 million accumulated depreciation. So we depreciated at $4 million over the last 10 years. Due to the changes in the market, the company realizes it will only be able to recoup a fraction of its $6 million value. The company estimates that the fair value of the equipment is $1.5 million. So it's taken a hit, and it could be technology based. It could be changes in the market. We really don't know here, but it's now only worth $1.5 million. Prepare the journal entry related to the impairment of their equipment. So step number 1 is we're going to eliminate the asset's accumulated depreciation against the asset itself. So if you notice here, we did calculate the accumulated depreciation at $4 million. So the asset's cost minus what it's worth in our books would give us our accumulated depreciation. So $4 million. So how do we write off our accumulated depreciation? Well, if you remember, if I draw some T's here, if I have the equipment and then I have accumulated depreciation, we've been putting the equipment, when we acquire it, we debit it. So to bring it down in value, we need to credit it, which means on the accumulated depreciation, we're going to need to debit it because when we incur accumulated depreciation, we are crediting the accumulated depreciation. So let's go ahead and write this down. So we know that we're going to debit accumulated depreciation. So accumulated depreciation in the amount of $4 million. And we're going to credit the asset, bringing the asset's value down. So in this case, it's an equipment for $4 million. So that would be writing off our accumulated depreciation to zero. So now our accumulated depreciation is zero, and then our asset's value has fallen from 10 million to 6 million. Now that's done. Now step one is done. In step two, we need to write down the asset to its fair value. So step two, write down the asset to its fair value. So right now in our books, we show the asset at $6 million, which is the 10 million minus the 4 million that we just dinged it in step number one. So we have it at $6 million. The equipment's fair value is $1.5 million, which means it has lost a value of $4.5 million. So we are now going to reduce the asset further by 4.5. And the question is where does the rest go? The rest goes into a new account called loss on impairment or impairment loss, either one. So we're going to debit impairment loss for $4.5 million. And we're going to credit equipment, writing it down even further to $1.5 million. So now our equipment's on our books for $1.5 million, which is the fair value of that asset. Now, what about this impairment loss? Well, the impairment loss means that we're going to have to reduce our net income by $4.5 million. That's not necessarily a great thing, especially when we want our net income to be as high as possible in the eyes of our shareholders. Now, where does this impairment loss go? This impairment loss should be reported on the operating expense side in the income statement. So on the operating side, you're going to put an impairment loss of $4.5 million. Means that you're going to take a hit on your income statement, but it is what it is. You're not going to recoup it anyway. So we're just going to have to write it off. Luckily, you didn't lose that cash per se because the cash outlay happened 10 years ago. So it's not that you lost $4.5 million in cash. Well, you did, but that cash was outlaid 10 years ago. And 10 years ago, you couldn't have bought the equipment for 10 million minus 4. You couldn't have bought it for 5.5 million anyways. You were just going to have to buy it for 10 million and then just take the loss here of $4.5 million. So that's where we would put it on the income statement. So that is a look at the asset impairment loss. A couple of key things here, making sure that we do the journal entry associated with the write-off on the accumulated depreciation. And then in step two, writing off the new value of the asset in our books, which would be 6 million, by the amount that its fair value. So the difference of those two would be your impairment loss. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and I'll take you to that video. So until then, we'll see you in the next lesson.